Hey everyone, welcome back to Corporate Decoder, the place where we break down these dense financial reports so you don't have to. Today we're diving into a filing that is all about private markets, and frankly it reads like a choose-your-own adventure for investors with a high tolerance for risk and a very long time horizon. This document isn't your typical earnings report. It provides a prospectus for investors looking to put their money into the Carlyle AlpInvest Private Markets Fund. Think of it as a detailed map of where your money might go and the wild terrain it might traverse. The main story here is about how this fund invests in private markets. At least 80% of its assets go into things like directly buying stakes in companies or buying existing stakes in other private equity funds and companies. They also invest in less glamorous stuff like loans to private companies to manage their cash. The fund is structured into different classes of shares class, A class, W class, I, and class X, each with its own set of fees and expenses. This is important because it means that even though everyone is investing in the same pool of assets, how much you pay to get in and how much you pay to stay invested can vary quite a bit. For example, if you buy Class A shares, you could be looking at a sales load of up to 3% of your purchase price. Class W shares have a slightly smaller load of up to 2%, and Class I shares, the most exclusive ones, carry no sales load. The fund is offering a massive $5 billion worth of shares in total, which is quite a sum. But remember, this is a prospectus, not a guarantee of investment success. It lays out all the risks in painstaking detail. Now let's peek at the financial highlights for Class I shares. For the year ending the 31st of March 2025, these shares saw a total return of 21.74%. That sounds great, right? And for the year ending the 31st of March 2024, it was 15.93%. However, looking at the ratios, it starts to paint a slightly different picture. The ratio of expenses to average net assets excluding fee waivers is a rather hefty 4.13% for 2025. This means a significant chunk of your potential gains goes straight to covering operational costs. It is important to note that these figures are for Class I, which has lower fees. For other classes like Class A, the expense ratio is much higher at 7.30%. For Class W, it is even higher at 15.48%. So while the gross returns might look appealing, the actual money you keep can be significantly reduced by these fees. Interestingly, the net investment loss for Class I shares was 0.36% in 2025. This means that after accounting for all investments and expenses, the fund actually lost a little money on its investments before considering any market gains. It is important to note that these financial highlights are derived from financial statements which have been audited, and these kinds of figures are really about the past performance and do not guarantee future results. The report mentions fee waivers from the advisor to limit expenses through July 2026. This is a common tactic to make the fund more attractive initially, but it is crucial to understand that these waivers are often temporary and the true cost of owning these shares could be significantly higher once they expire. The expense ratios including fee waivers are still very high, especially for Class A and Class W shares. Take Class W for instance, their expense ratio including waivers is 15.48%. This is a huge drag on any potential returns and means that the fund needs to perform exceptionally well just to break even after fees. For Class I shares, they started the year at 11.90 per S-share and ended at 14.46 per S-share. This shows a healthy increase, but as we saw, the expenses significantly eat into this if you look at other share classes. Then there is the whole structure of the fund itself. It is an unlisted closed-end fund, meaning there is no easy way to sell your shares on a stock exchange. Liquidity is mostly provided through periodic repurchase offers at the fund's discretion. This is a big deal for investors who might need access to their money quickly. The document goes on to detail a lengthy list of risks. Some of them sound pretty standard, like market fluctuations and geopolitical risks, but then there are others that really highlight the unique nature of this investment. The fund has a limited operating history and faces intense competition for investments which could reduce the number of opportunities available. There is also a risk that the fund might overcommit its capital, leading to potential penalties if it cannot meet its obligations. This is a significant risk to consider. Ultimately, the fund aims for long-term capital appreciation, but the path to get there involves investing in private markets which are inherently illiquid and less transparent than public markets. This means a long-time horizon is not just recommended, it is practically required. The filing also acknowledges significant geopolitical risks, including the ongoing conflict in Ukraine. This is not just a news headline, it directly impacts investments by creating market volatility, reducing liquidity, and potentially devaluing assets, especially those with exposure to affected regions. Let's talk about the limited operating history risk. This is a polite way of saying the fund is relatively new. When a fund doesn't have a long track record, it becomes harder for investors to gauge its performance history and how it might handle different market conditions. Established funds with years of data offer more predictability, whereas newer funds are essentially experiments with your money. Scroller's net ERect investments 15.7% scroll. Looking at the prior performance for AlpInvest related fund accounts, which are the benchmarks for this fund, we see some interesting numbers. For direct investments, the net internal rate of return or ERR life to date is 15.7%. For secondary investments, it is 17.1%, and for primary investments, it is 11.6%. These numbers are presented before many fees and expenses that retail investors will face, further reducing net returns. They also mention that their fund fees and carry terms are often substantially lower than what this particular fund charges, meaning your actual returns could be much lower than these historical figures. Scroller's 1 year, direct investments 7.2% scroll for the past year, direct investments return 7.2%. Secondary investments 8.0% and primary investments 7.1%. These are respectable returns, but remember these are gross figures before the fund's own substantial fees are deducted. Now for my take on all of this, Carlyle AlpInvest is a big player in private markets and their track record shown in this filing is solid. They clearly know how to source and manage private investments. However, this fund has some significant drawbacks for the average investor. The fees are high, especially for the less exclusive share classes. The illiquidity is a major concern, meaning your money is locked up for potentially a very long time. The risks detailed are extensive, and frankly the complexity of investing through multiple layers of funds and managers adds another layer of opacity. If you are a sophisticated investor with a very high risk tolerance and deep understanding of private markets and absolutely no need for liquidity, then perhaps this fund could be a part of a diversified portfolio. For most people though, the high fees combined with the illiquidity and extensive risks make this a very difficult investment to recommend. It feels like a fund designed for institutional investors or very wealthy individuals who understand and can absorb these specific kinds of risks and can weather market downturns without needing immediate access to their capital and are comfortable with the high fees involved over the long term. Alright, that is our decode of the Carlyle AlpInvest Private Markets Fund Prospectus. What is your take on these numbers and what they signal for the company's future? Do you think the high fees and illiquidity are worth the potential for private market returns? Drop your thoughts in the comments. If this analysis was valuable, hitting that like button really helps, and subscribe for more deep dives into corporate finance. And don't forget to check out the Discord community linked in the description below for more exclusive content and discussions. Thanks for watching. See you next time.